Hi, everyone. Welcome back to our 5th episode of the Enrich Your Journey podcast. Thanks for being here. As always, the goal of the podcast says it right here: educate, story sell, entertain, and provide a call to action. I will do my best to entertain with this topic today. That might be a little bit of a challenge, but nonetheless, we'll make it hopefully worth your time. Maybe you go away learning a couple things and maybe it applies to you. I'm your host, Patrick Monahan, accredited investment fiduciary partner, financial advisor with Trilogy, headquartered right here in St. Louis, serving high net worth investors all over the country. And again, thanks again for being here today. The topic I have today is one that is very intriguing, not talked about a lot. Most clients, investors, prospects don't even know about it. So here we are. I thought it might be a good one to talk about in the next 5-10 minutes, and hopefully maybe it applies to you. This topic is called Net Unrealized Appreciation, or NUA. If you ever wanted to know how to get the most out of your company stock inside a retirement plan by minimizing your tax burden, you're in the right place. So let's get started. To help understand NUA, let's first establish what it means. It's a tax provision that allows individuals who hold company stock in your employer-sponsored retirement plan, such as a 401k, to basically take advantage of a significant tax savings by shifting a certain portion of the stock value to a different tax. And I'll explain that in a minute. So all we're really talking about is 3 values here, and we're modifying one of the values to a different tax. You have your fair market value of your stock. You have the cost of that stock. So what you bought that at all the way back to when you bought it. Could be over decades, right? If you've worked for ABC company for 3 decades and you've been buying their stock inside your 401k, that's your cost, your total cost, even though it has different share classes or different tax lots, as we call them. Total cost, and then the difference of those two is your unrealized gain. You haven't sold it yet. So if you got a stock worth $500,000, you've bought it for $100,000 over all these years, you have a $400,000 unrealized appreciation. That's your gain. That's what we're talking about today. So let's talk about how it works, right? So those are the 3 values. That's all you need to know for today. So you've got this appreciation. All you need to know is that we're going to focus on the cost basis of the stock. If you do not elect what I'm speaking of today, net unrealized appreciation, if you don't elect that with the IRS in the year that you distribute these monies from your 401k, that distribution from your 401k is taxed at your ordinary income. Just consider that your highest tax, right? That's ordinary income is same as your salary. Any earned income, that's all at ordinary income. So think of the tax bracket. Currently, as we sit right now, the highest bracket is 37%. That is set to go back in 2026 to 39.6%. That's what we're talking about today. So just in general, whether you have company stock or not, if you take assets out of your 401k, whether it's a triggering event, you've retired, maybe your plan allows for a hardship withdrawal, whatever the case may be, that's all taxed at income because it's never been taxed before. You put all that money in there, tax deferred. You were reducing your income while you were saving those accounts. If it's in a 401k, so you're paying tax on the way out. So what we're talking about is when you take that stock out, if you elect NUA by one of these triggering events, we can actually have your cost basis, the net unrealized appreciation, taxed at a capital gains rate versus income. So in the example I said earlier, $500,000 in stock of ABC company, you bought it for $100,000, you got a $400,000 unrealized appreciation. By electing this NUA, that $400,000 could be taxed at capital gains rates versus ordinary income. So just to give an example, if you're in the highest brackets all in, you're talking 37% on ordinary income versus, depending on state and your income, either 15, 18.8, or 23.8% capital gains tax. So if it's 15, you're going from 37 to 15. You've cut that tax in half on that $400,000. This is huge. This is a massive tax savings, and that's it. That's the strategy. Now, of course, there's certain requirements. So here's a couple of them I'll read. First, you must be eligible. I mentioned this for a lump sum distribution from your retirement account. This is really important. You need to understand what your 401k allows in terms of taking money out. I mentioned it has to be a triggering event. Typically, that's due to retirement, reaching the plan's defined age of distribution, disability, or death. So obtaining the plan document from your HR department or whomever is administering the 401k and understanding your ability to access that stock out of your 401k as step number one is critical. Because if you're not at the appropriate age, 59 and a half, you haven't retired, you don't have disability, you may be ineligible for this anyways. If you do check those boxes, this again, and you've got a significant unrealized gain in company stock, this plan could absolutely make sense for you. Second, the distribution must occur in a single tax year. So you got to move it all out in 1 year. You can't, modify this over 2 calendar years. We're talking about getting this all done in one single calendar tax year. And then finally, the stock must be transferred to a taxable account. So you're going from 401k to an individual brokerage account, or 401k to joint account, or 401k to trust account. We are not talking about a 401k rollover, an IRA rollover. IRAs don't apply to this situation. 401k to a taxable account only. Couple downsides of this that may not make the most sense for you. It's important to consider factors such as your overall tax situation, weigh the tax savings against the market risk associated with holding a single security, as well as understanding that executing the strategy is not available and forfeited if the stock is transferred to an IRA. So again, we're not talking IRAs here at all, this entire episode. The 8 minutes we've been together, just 401k to taxable account. Taxable account defined as individual, joint, trust, anything that is not inside of an IRA or retirement account. So let's go through a quick example here. And I'll have this on the screen. We'll have a link to this example afterwards, so that it may make sense for the visual learners like myself. This is an example of stock that's worth $300,000. This investor had $125,000 cost. So ABC company, they had $125,000. They had contributed in their 401k and bought the stock over the years. It's now worth $300,000. This individual is retiring. So the strategy was to roll ABC stock out that's worth $300,000 to a trust account that they had already set up, and we elected the NUA strategy. By doing so, the cost basis was taxed as ordinary income because that went in tax deferred. We're in this example, it was a 28% tax bracket. That tax bill is $35,000 on that amount to the trust account. But the unrealized appreciation, which is $175,000, so $300 minus cost of $125, their gain, their profit on paper is $175. That $175 is taxed at capital gains because we elected NUA. So 15% versus 28%. Almost cut the tax in half. Again, massive. The tax on that, $26,250. So this individual moved $300,000 of ABC stock to their trust account and paid $61,000 in taxes. So call it had about $240,000 left over of the stock. Conversely, if this client had not consulted with us, took all the money out, put it to their trust because they needed it, they wanted it, they didn't want to do a rollover, that's a totally different strategy. But just for purposes of explaining NUA, they took the $300,000 out. They paid same tax, ordinary income of 28% on the $300,000. Now cost basis is irrelevant, goes away. That tax bill is $84,000. So we just saved this client almost $23,000. It's almost 8% in taxes by electing the strategy. So if you have highly appreciated company stock in your 401k, you absolutely need to be considering net unrealized appreciation strategy. If you check the boxes that it makes sense for you, You understand, you've consulted with your team, financial advisor, your CPA. You understand the tax consequences of doing so. You've got highly appreciated stock, and you have a triggering event in your 401k. Again, getting back to understanding what your 401k plan allows: disability, retirement, you're at the eligible age, 59 and a half. Check those 3 boxes. Please look this strategy up just to consider it. And then reach out and let us know if, confirm with your team of professionals, ourselves, if you are a good candidate for it. So that's the call to action. As I always like to put in episodes, the call to action: do your research, reach out. We're happy to walk through. We can run projections on this, see if this makes sense for you. And, as always, we'll include some more information, links after the episode. Tried to be entertaining. I don't know if I was on this one. This one's a little heavy, but hopefully you understand the concept enough that it may make sense for you. Thanks so much for your time. Please follow us. I'll also put a link to our website. If you could follow the podcast, that'd be great. And the last thing I'll ask you for also, if you have, I mentioned at the very beginning, this is our 5th episode. So we got a long runway here. If you have ideas, questions that you think may make sense, that you'd love to hear more about, send those to me. Right now, we're creating a laundry list of financial planning topics that we help our clients with. And, we're always looking for more ideas. What are you hearing out there? What's something that's on your mind? Would love to talk about that if it makes sense for both of us. Thank you so much. Have a great rest of your day. We'll see you soon. Bye-bye.